So you might be looking at the healthcare sector, in particular the healthcare providers, the insurance companies, and you might be thinking to yourself, what the heck happened? Well, what happened was two things. Number one, UnitedHealth came out with earnings, and for the first time, they expect their revenue to go down for the first time in almost 40 years. So that was strike number one. Strike number two, and basically strike number three, was that the federal government came out and said that they're not going to provide as much funding for Medicare as previously thought. Analysts were expecting between 4 to 6% for Medicare payments to these companies, and they're not even going to get 0.1% increase for the year 2027. So those two bits of information in combination sent healthcare stocks down quite a bit. We see that in the past month, Humana is down about 25%. UnitedHealth is down about 11%. Cigna and Elevance down between 1.5% and 2%. So not too terribly fantastic for these companies. So we look at these four companies over the past year and we see that all four of them are down. Cigna is down the least. It's down about 8.5%. And Elevance is down 13% even. Humana is down 35%. And UnitedHealth down a whopping 45% after that crash a few days ago. The past 5 years, half of them are up, half of them are down. So Cigna is up 36%, Elevance is up 23%, but UnitedHealth down 6%, and Humana down a whopping 48%. So does this set up for buying opportunities? Can we find some bargains and some steal deals in these companies, or are these companies things that we should just completely avoid in our portfolios? So we've updated the numbers for these companies. We see some very attractive valuations when it comes to forward PE. We see that Cigna and Elevance are coming in at 8.9 and 12.3 respectively. And we see all of their 5-year forward PEs coming in under 9. These are not growth companies by any stretch of the imagination. These are gigantic insurance providers. So we're not going to really pay too much attention to these numbers, but we will factor them into our scoring system, into our average score, as we tend to do on this channel. The worst company for growth is Humana, coming in at just a 2.8. Elevance is coming in tied also at 2.8. UnitedHealth at a 3.9, and Cigna coming in at 5.6. Now, if you are new to this channel, what we do is we score these companies based on a scoring methodology that ranks companies between -10 and +10. -10 is the worst, +10 is the best, and 0 is neutral. So all four of these companies are coming in above neutral, which is good. We like to be picky and choosy with our companies. However, we want to make sure that we allocate our capital and invest into quality companies. And so we typically choose companies that have scores of 5 or higher. So only one fits the bill when it comes to growth, and that is Cigna. Safety metrics have also been updated after UnitedHealth reported their earnings. We see that all four companies offer a dividend. 3 out of the 4 have grown their dividends. Humana has not. Cigna coming in at 2.4%, and UnitedHealth, with that gigantic drop in stock price, now they are offering a 3% dividend yield. The problem is that their payout ratio is 66%. That is getting a little too close for comfort to numbers in the 70s and then the 80s. And so the question is, can UnitedHealth maintain their dividend growth? Now, they've grown their dividends for 16 consecutive years, which is fantastic. But given all the legal and the financial and the corporate problems that this company is facing, the question is, can they maintain that dividend growth into the future? Now, these safety scores are probably going to be better indicators as to the health and the value of these companies. And so Humana's coming in at a 5, which is interesting because, again, 5 is kind of the baseline, the floor of what we would consider for any company. So Humana does have a decent safety score. Elevance comes in tied, also at a 5, and UnitedHealth coming in at a 6.2. And once again, the top of the leaderboard, Cigna coming in at a 6.9. So in addition to the scoring, we want to make sure that the price of these companies is priced right. We want the best bargain with the best value for our dollar that we can possibly get. And so in the description of this video, you'll find 4 links that show you how to build out intrinsic value calculators, which are absolutely necessary for the investor. So we show you how to do the PE ratios model, the dividend discount model, the discounted cash flow model, and the Peter Lynch valuation model. As we've noted in previous videos, the Peter Lynch valuation model is rather bullish, and so we're going to exclude it here and update that in future videos. However, since all 3 companies pay decent dividends, we are going to do the PE ratios model and the dividend discount model and the discounted cash flow model for these companies. So if you get anything out of this video, remember, please like and subscribe. come back to the channel, subscribe, get that notification so that way you can get more financial advice for these types of companies and all the companies that we consider at Interflame Finance. And also remember, before we get into the intrinsic values, that nothing that we say on this channel is financial advice. We're not telling you to buy, hold, or sell anything in your personal portfolios. Always do your own research, always do your own due diligence. And one of the best things you can do is by building out your own intrinsic value calculations and seeing what these companies are actually worth compared to what the market is currently selling them for. So first we see Elevance Health, worst score, average at a 3.9, growth was 2.8, and safety was 5. Intrinsically, we think that Elevance is actually worth $450. It's currently trading for $347, and that gives us a 23% margin of safety. So we think Elevance is worth $450. We look at analysts and we see that that is at the mid to high range of what analysts expect. Analysts expect an average of $393 by the end of the year. That would imply a 15 to 17% increase in the stock price. That high would be about a 42% increase in the stock price, and the lowest estimates coming in at 297. And so what we see here are 4 strong buys. We see 7 buys, 7 holds, 0 sells, and 0 strong sells. So a lot of holds and buys for this company. They think that the price implies about a 15% increase for Elevance Health. Next up is Humana, identical scores with Elevance. We see, however, that the intrinsic value is $320 and they are currently trading for $195. That implies a margin of safety of 39%. If we look at Humana's expectations on Wall Street, we see that there's an average of $290 per share. That would imply a 50% increase from its current stock price, which is just phenomenal. The high expectation coming in at $345, that would be about a 78%. Now remember, we are coming in at a $320 expectation for the intrinsic value for Humana. So $320 is at the almost the upper end of what analysts expect. There are 2 strong buys, 4 buys, 12 holds, 0 sells, and 0 strong sells. So the consensus is just a tick over hold. It's into the buy range. But given this company's expected stock price of $290 on Wall Street, and based on our expectations of $320, this might be something to consider. The only downside is that their average score is a 3.9, not the strongest score that we'll see today, because next would be UnitedHealth, which does come just over our recommendation of 5 or higher. Growth, not too fantastic at 3.9. Safety coming in at a 6.2. Intrinsically, UnitedHealth, we believe, is $415 per share, currently trading for $292. That would imply a 30% margin of safety. And so for UnitedHealth, we see that our expectations of 415 are pretty much in line with what Wall Street expects. We are just slightly more bullish than that. However, the high expectation coming in at $575, that would be almost a doubling of its current stock price. However, average on Wall Street expects about a 35 to 36% increase on average over the next year. There are 7 analysts saying strong buy, 13 saying buy, 3 saying hold, 2 actually saying sell, and 0 saying strong sell. And so take that into consideration and do with that information what you want. But this is a company that does come in at a 5 or higher for our average score, and it does have a fantastic margin of safety of 30%. And finally, we have Cigna. Cigna coming in with the best score at 6.25. The current price is $272. Intrinsically, we believe it's $375. That $375 is a little higher than the average on Wall Street. Wall Street thinks it's going to come in at $354 per share. That would be between a 30 and 36% increase in its stock price on average. The most bullish analysts think that it's about $390 per share. That would be a 43% increase over the next year. And the low estimate is even coming in at an 8% increase at $294 per share. There are 6 strong buys among analysts. There are 9 buys, 2 holds, 0 sells, and 0 strong sells. So there you have it. All 4 of these companies have pretty decent margins of safety. Only 2 companies are coming in at a 5 or higher. That would be UnitedHealth and Cigna. So I just do want to point out that in a previous video about 5 or 6 days ago, we had UnitedHealth coming in at an intrinsic value of $525. And so you see that there's been an over $100 decrease in our intrinsic value based on these reports. And so that does come with the territory of predicting stock prices just before earnings. Is the lowering of their revenue for the first time in 40 years does drop their stock price. And we couple that with something completely unexpected, which is the federal government not funding Medicare nearly as much as analysts were expecting. Again, analysts were expecting a 4 to 6% increase in Medicare funding, and that's actually going to be basically 0% over the next year into 2027. So things like this come out of nowhere, and that's why diversification is so incredibly important. If you put all your eggs in one basket, and bad news hits a company, bad news hits a stock that comes out of left field, that comes out of nowhere, you're probably going to see a drop in your portfolio. You spread your money out, make sure you always do your own research and your own due diligence, have some sort of methodology for scoring and analyzing stocks, look at their balance sheet, look at their income statement, making sure that you are always investing in quality companies. So again, nothing that we say on this video is financial advice, but we do appreciate you being here and looking at this video for educational and entertainment purposes only. Please feel free to like this video if you got anything out of it. Subscribe to this channel so you can keep coming back for more financial information and intrinsic values and scores based on the Interflame Finance methodology. We appreciate you being here, and we'll see you in the next video.